Financial scams often begin with a story that sounds organized, personal, and emotionally believable. The invitation may start with a friend, a group chat, a mentor, a trading screenshot, or a case study about someone who supposedly changed their life. The danger is not only the promised return. The danger is that the story moves your attention away from verification and toward action. Before money moves, use 3 stop signals. The first stop signal is a return story without a clear risk source. The second stop signal is artificial urgency that makes normal due diligence feel like hesitation. The third stop signal is an opaque information path where everything depends on an introducer, a private chat, or an app that you cannot independently verify. The second stop signal is urgency. Many victims are not careless. They are placed inside a situation designed to make caution feel embarrassing. The group may say there are only a few spots left. The mentor may say the platform will close registration tonight. Other members may post payment screenshots. A representative may say that a bonus, allocation, or withdrawal window expires soon. The purpose is to compress your decision time until verification feels like disloyalty. Build a personal rule. Any investment invitation that requires same-day wire transfer, borrowing, account sharing, crypto transfer, remote control software, or an unfamiliar app must wait at least 24 hours. A legitimate service can survive 1 day of verification. The third stop signal is opacity. Scams frequently create a complete-looking world, customer service, dashboards, performance charts, chat rooms, official-looking names, and withdrawal messages. But when you ask for the legal company name, regulatory status, custody arrangement, fee schedule, withdrawal terms, risk disclosures, banking information, or a written contract, the answers become vague. You may be told not to overthink, not to miss the chance, or not to ask outsiders. That is a major warning. Information rights are not an insult. They are part of financial safety. If the payment account does not match the claimed company, if verification links come only from the seller, or if the platform cannot be checked outside the story, stop. Verification should happen outside the story. Write down the names, websites, company identifiers, bank accounts, wallet addresses, app names, and contact details. Do not rely on a link sent by the seller to prove the seller is real. Check regulators, official exchanges, company registries, known bank channels, and independent sources. Ask why funds must go to a personal account, why crypto must be purchased first, why withdrawal rules are not written clearly, or why the platform cannot provide ordinary documentation. Then discuss the offer with someone who is not inside the group and has no incentive to close the sale. Scams are strongest when the story controls the room. A useful evidence ladder has 4 levels. Level 1 is a marketing claim. Someone says the strategy works. Level 2 is a screenshot. The claim appears inside an app, chat, or dashboard, but you still do not know whether the numbers are real. Level 3 is an independently verifiable record, a regulated entity, official filing, bank or brokerage statement, public registration, or contractual document that can be checked outside the seller's channel. Level 4 is a complete money path. You understand where funds are held, who has custody, how withdrawals work, what fees apply, and what legal party is responsible. A scam tries to keep you at levels 1 and 2 while making them feel like levels 3 and 4. Use a scenario matrix before sending funds. In the optimistic case, the opportunity works and your money remains accessible. In the ordinary stress case, returns slow. The market falls or withdrawals take longer. In the fraud case, the dashboard is fake and the operator disappears. For each case, ask what evidence you would have, what action you could take, and whether your position size would still be survivable. If the only plan is to trust the seller, the position is too large, or the opportunity is not ready for your money. Be especially careful with small successful withdrawals. A platform may let you withdraw a small amount to build trust, then encourage a larger deposit. That first withdrawal does not prove the platform is safe. It may be a customer acquisition cost for the scam. Look instead at custody, regulation, ownership, audited records, and large withdrawal rules. When the next step becomes borrowing, upgrading, paying a tax to unlock funds, paying a guarantee deposit, or adding more money to release earlier money, the frame has changed. You are inside a classic escalation pattern. The correct response is to stop paying and preserve evidence. If you already sent money, the next actions matter. Do not pay another fee in order to recover the first payment. Save screenshots, URLs, phone numbers, bank details, wallet addresses, transaction receipts, app screens, and every instruction you received. Contact your bank, payment provider, or exchange as quickly as possible and ask whether a transaction can be flagged, frozen, reversed, or traced. Report through the appropriate police, fraud, or consumer protection channel in your country. Also warn family members because recovery scams often follow the first scam. Someone may pretend to be a lawyer, investigator, exchange officer, or government agent who can recover the money for another fee. Finally, separate verification from politeness. You do not owe an introducer a fast answer because they were friendly, persistent, or recommended by someone you know. A clean process sounds like this. I will review the legal name, custody arrangement, written terms, withdrawal rules, and regulatory status. If those cannot be verified independently, I will not proceed. This sentence protects the relationship and the money at the same time because it makes the decision about process rather than personal trust. Make the stop signals part of your household process. Decide in advance that any unfamiliar investment involving wire transfer, leverage, crypto transfer, account access, collateral, or a new app needs a written check before payment. Set a second-person review threshold for larger amounts. Good investments can tolerate documents, risk explanations, transparent custody, and time. If all you have is a good story, pressure, and unclear information, stopping is the most valuable action. Another practical test is the account name test. A regulated investment relationship normally has a coherent chain between the business name, the agreement, the account receiving funds, the custodian, and the withdrawal process. If the public brand name, the contract name, and the bank account owner do not match, do not let the seller explain it away with convenience. Ask for a written explanation and verify it independently. If the money must move through a personal account, a chain of wallets, a gift card purchase, a third-party merchant, or a payment reference that hides the purpose, the payment path itself is evidence. You do not need to prove criminal intent before deciding not to proceed. Position sizing is also a fraud defense tool. Scammers push people to move from curiosity to commitment by making the first payment feel small and the second payment feel urgent. They may use a small win to reset your risk tolerance, then ask for a larger deposit before you have completed verification. A protective rule is to separate trial size, verification size, and life-changing size. Trial size should never require borrowing, secrecy, or emergency savings. Verification size should wait until documents, custody, and withdrawal rules are clear. Life-changing size should require independent advice, written records, and time. If an offer pressures you to skip these stages, the process is the warning. Family and workplace boundaries matter because scams often exploit isolation. If someone tells you not to mention the opportunity to a spouse, parent, colleague, banker, accountant, or licensed professional, treat that secrecy request as a separate red flag. If the seller says outsiders will not understand, ask why a legitimate investment cannot survive ordinary questions. If the answer becomes emotional rather than factual, pause the conversation. The point is not to embarrass the introducer. The point is to move from social pressure to written evidence. Money decisions become safer when they can be explained calmly to a person who is not trying to close the sale. Digital security is part of the financial decision. Do not install remote control software, screen sharing tools, browser extensions, unknown wallets, unknown trading apps, or configuration profiles just because a mentor says it is necessary. Do not share one-time passwords, seed phrases, private keys, identity documents, or account screenshots through a chat group. A real platform should not need control of your device to help you invest. If the investment process requires you to weaken your own security, the expected return is no longer the main question. The first question is whether you are handing over the ability to move money without your informed consent. There is also a communication pattern worth naming. A fraud pitch often changes topics when you ask a precise question. You ask about custody, and the seller answers with another success story. You ask about regulation, and the seller answers with a screenshot. You ask why the account name is different, and the seller says the finance department handles it that way. Write down the question and the actual answer. If the answer does not address the question, count it as missing evidence rather than as a partial explanation. This protects you from being persuaded by confidence instead of substance. You can turn the process into a 5-minute checklist. First, identify the legal counterparty. Second, identify the asset or activity that supposedly creates the return. Third, identify who controls the money between deposit and withdrawal. Fourth, identify what written rule lets you exit. Fifth, identify who you can complain to if the platform refuses. If any answer is blank, delayed, or only available through the promoter, the opportunity has not earned your payment. The checklist does not need to be complex. It only needs to be completed before the money leaves. For older relatives, new investors, or anyone under stress, pre-commitment helps. Decide before an offer appears that no urgent investment decision will be made alone. Decide that no one in the household will borrow money, liquidate emergency reserves, or transfer crypto for an unfamiliar opportunity without a second review. Decide that a person who pressures secrecy loses the right to receive money. These rules may feel strict, but they are easier to follow when written before emotion enters the room. The safest conclusion is not that every high return story is automatically false. The safer conclusion is that high return stories require higher quality evidence, more transparent custody, smaller initial exposure, and more time. When the evidence quality does not rise with the size of the promise, the risk is not being compensated, it is being hidden. That is why the stop signals are valuable. They move your attention from the excitement of the story to the structure of the decision. A final protective habit is to keep a written decision note. Before paying, write one paragraph that names the counterparty, the source of return, the worst-case loss, the withdrawal rule, the independent evidence checked, and the reason the position size is acceptable. If you cannot write that paragraph without copying the promoter's words, you do not yet understand the investment well enough to fund it. The written note turns pressure into a reviewable decision record.